Hey everyone, welcome to the video. My name is Alex, a former financial advisor turned real estate professional. Today we're going to be breaking down the top tax changes that are coming to Canada in 2026. Now, some of these are really good news, like more contribution room in your registered accounts, even a small tax cut, while others mean slightly more CPP deductions off your paycheck. Today, I'll be walking you through the updates that actually matter to your wallet for everyday Canadian. And if you find this video helpful, then hit the like and subscribe buttons. It really helps the channel grow. I would really appreciate it, but it also allows for more Canadians to find practical information such as this video. With that being said, let's get started. So let's start with the TFSA, the tax-free savings account. So as long as you're over 18 years old, you will be getting another $7,000 of contribution room for 2026. It's the same dollar amount as last year and doesn't make it any less powerful. Keep in mind your total contribution limit is the sum of all years' contribution limits from the year that you turned 18 years old. If you've never contributed to a tax-free savings account ever, and you were at least 18 years old in 2009 when the account was introduced, then you would have a lifetime contribution limit in 2026 of $109,000. Now that is $109,000 that you can invest completely tax-free. And if you recently moved to Canada, you will start earning contribution room towards your TFSA the moment you become a Canadian resident with a SIN number. But remember, your TFSA is not just a savings account. The biggest mistake that Canadians make is leaving TFSA money in straight cash. Use your TFSA for investments like ETFs or index funds or even GICs if you have short-term goals. Just make sure it's growing and not slowly losing to inflation. You don't want to be using your tax-free account to not make any gains, right? That's like wearing sunscreen indoors. And if you need a full breakdown on the TFSA, I've got just the video for you. I'm going to leave it in the description below. Go check that out right after this one. Moving on, next up, we're going to talk about the RRSPs. Now for 2026, the CRA RRSP contribution limit is increasing to $33,810, which is up from $32,490 in 2025. So what does that actually mean? Well, your contribution room in your RRSP is actually 18% of your previous year's earned income up to the CRA maximum for the year, which we just saw for 2026 is going to be $33,810. So for example, if you made $80,000 in 2025, then you're going to earn $14,400 of new RRSP room for 2026. Now, if you made $200,000, for example, you're going to be capped at the CRA limit for the year. RRSPs are great for reducing taxes. So if you're in a higher tax bracket now than you will be at retirement, which by the way is almost everyone, then you're going to get a permanent tax savings, which is great. And you definitely should take advantage of it. And don't forget the RRSP deadline to count towards your 2025 taxes is March 2nd, 2026. But once again, make sure you're actually investing the money that's in the account. The RRSP is for long term. The money inside the account should really match that goal. If your RRSP is just sitting in cash, you might not realize it, but it's slowly losing you money. Once again, I've got a full breakdown of the RRSP. I'm gonna leave a link to it in the description below. Go check it out right after this video if that's what you need. So now let's move on to my personal favorite account, the FHSA. If you're planning to buy your first home in Canada, then the FHSA or the First Home Savings Account is still the most powerful tool that you have access to in order to save up for your down payment to buy your first home. You get $8,000 of new contribution room up to the same lifetime maximum of $40,000. So no changes yet. However, I do expect the $40,000 lifetime limit to change sometime in the near future. Now, here's the key detail about the FHSA. You can actually contribute for last year's limit as long as it wasn't used and the account was open during the year, which means if you haven't opened the account yet and you're eligible, then do it before December 31st. It's completely free, and most banks nowadays just allow you to open it online in the matter of seconds. Even if you don't deposit anything right away, you can still carry forward that $8,000 of contribution room of 2025 into 2026 as long as the account was open. So if you wait till January 2026 to open your FHSA, you're going to miss out on your contribution room for the year of 2025. big mistake. And remember, the FHSA is the best of both worlds. You get tax deductions just like in the RRSP, and you get full tax-free withdrawals when buying your first home. Once again, if you need a full breakdown on the FHSA, I'm going to leave a link in the description below for a video that I've made on the topic. Go check that out after this one if that's what you need. So let's cover the federal tax rates now in 2026. Federal taxes are going down in 2026. Actually, they've already went down in mid-year of 2025, but a little bit different. So let me break it down. The lowest tax bracket drops from 15% at the start of 2025 to now 14% in 2026 on your first $58,523 of income. Now, this rate drop actually did happen in mid-2025, which is why you're going to see that the 2025 lowest income tax bracket is 14.5%. That means that in 2026, we're going to get a fresh, new, clean 14% on the lowest bracket. That means everyone is going to benefit from a 1% tax deduction at the lowest tax bracket, which is up to that $58,000 mark. That is roughly $585 of tax savings per year. In addition, the tax brackets are expanding by about 2% to keep up with inflation, which is pretty standard, which means the lowest tax bracket in 2025 was $57,375 or less, is now becoming $58,523 or less in 2026. So more of your income is going to be taxed at lower tax brackets. Now, here's a simplified breakdown for 2026 of the new tax brackets. Now, keep in mind, these are the federal numbers. Each province has their own brackets, but overall, most Canadians will see a slightly higher take-home dollar amount, but do not confuse that with purchasing power. Now let's talk about CPP or Canada Pension Plan. So Canada Pension Plan, CPP contributions are increasing this year once again. The contribution rate stays the same at 5.95%, both for employees and employers. And if you're self-employed, you have to cover both portions. Essentially, you're paying double, but the income limits are going up. So in 2026, the year's maximum pensionable earnings, or YMPE, increases to $74,600, and the second tier rises to $85,000. That means that higher income earners are going to pay more in CPP up to a certain maximum. If you make under this amount, no change. If you make in between these two amounts, you're going to pay slightly more. And if you make anything over $85,000, then you are going to contribute the maximum for the year, which is $4,646 for 2026. And like I said, if you're self-employed, you have to cover both the employee and the employer contributions. Essentially, you're paying double. But keep in mind, this is not just a tax, this is also your retirement income later on. And the more you contribute, the higher your monthly payments will be in retirement. Now, moving on, another little win for Canadians is the basic personal amount is increasing yet again. The basic personal amount is the amount of income that you can make completely tax-free, but only at the federal level. So for 2026, it's going up to $16,452, up from $16,129 in 2025. So if you earn less than that, then you will not be paying any federal taxes. Do not forget about provincial taxes, however. For everybody else, it counts as a tax credit, essentially just reducing your taxes payable. And for higher income earners above $181,000, then this tax credit starts to phase out slowly. But for most Canadians, it's a straightforward benefit. Now for a quick update on the capital gains situation that we had last year. The proposed increase to the capital gains inclusion rate, where 2/3 of your gains would be taxable rather than the half that we currently have, has been scrapped. We are staying at the 50% inclusion rate. Do not worry. So if you sell any investments or property and incur a capital gain, then only half of that gain will become your taxable capital gain. If this change actually went through, this surely would have caused many businesses to move their operations to another country, thus reducing job opportunities and creating more inflation. So whether or not you actually have capital investments, this is a win. And for small business owners, there's another nice little change. The lifetime capital gains exemption is increasing to $1.275 million, up $25,000 from 2025. 2025. That means that if you sell your incorporated business, well, then the first 1.275 million in capital gains is completely tax-free. So here are a few tax deadlines to mark down for 2026. March 2nd, 2026 is the RRSP contribution deadline to make it count for your 2025 tax return. It's very important for last-minute tax planning. Now, April 30th, 2026 is your deadline to file taxes if you're an employee, and if you're self-employed, the deadline is June 15, 2026. But keep in mind, you still need to pay any taxes owing by April 30th to avoid any interest. So with that, that's a wrap for the tax changes that are coming to Canada for 2026 that are affecting most Canadians. Overall, a net positive for most Canadians this year. If you found this breakdown helpful, then hit the like and subscribe button and share this video with a friend who is planning their 2026 finances. And if you still haven't watched it yet, be sure to go check out the top 9 TFSA mistakes that Canadians still make in 2026. It's going to save you a lot of money in the long run. That being said, thanks for watching. Until next time.